What's up, YouTube? It's your latest and greatest YouTube personality, Kory. I am so excited you're checking out my LG channel again. Thank you for checking me out. If you haven't yet, please subscribe below, and you'll get access to other great videos like this one today, which I'm actually going to talk about investing tonight because I've been talking to a lot of people today about investing, so I figure it's fresh on my mind. And I wanted to talk about a couple of things, really. Um, in my opinion, some key factors to your accumulation phase of investing, and specifically dividends and compound interest and fees and time. Okay, now these are four things that are very important when it comes to investing for your future. I'm actually going to work backwards in this list to get back to dividends, but those are very important. So stay tuned for the rest of the entire video to learn why dividends and compound interest are so important. I'll explain those in a bit, but first of all, time. Time is such an important aspect or piece or component or it's just such an important piece of investing. So time is basically something that you cannot control in terms of speed. It is what it is. You're going to wake up every day and it's going to be a new day, and that day is going to start 24 hours between the one before. Okay, right? And guess what? You only have so many days on Earth. So time is limited, but some of your time is going to be spent accumulating money and accumulating wealth, so that some of your time later in life can be spent not working, right? That's called retirement. Retirement is when you no longer work for money, or you no longer go to work. You're just not basically committed to employment. Okay. So what does this time thing really have to do, and what am I saying? I'm gonna sum this up in a couple of minutes here, but it's so important because if I were to tell you what are the two most important things I wish I would have known sooner with investing, it's to invest sooner and more often. Okay, right? So in the course of time, you will have only so many opportunities to invest. If you can increase those opportunities throughout time and invest more often, and if you can invest money sooner, you're going to be better off than somebody that has invested less often and less sooner than you have. Okay, that is the power of time. So if somebody has perhaps started a Roth IRA or an account for you, and it's been growing, and all of a sudden you turn 18 and you're going to college, or maybe it's a 529, you'll be amazed to see that just the small investment of maybe a few $1,000s, how much it's grown over time if invested properly for a person in the accumulation phase. Now, this is somebody with a high stock allocation that could see it grow quite huge. If you're less if you're risk averse and your investments aren't such high growth, maybe it won't grow as much. But the power of time is going to be there. Like if you started this at the birth of your child and they go to college at 18 years of growth are there for you. If you weren't able to put any money in until your child was 5, and it would take you basically 5 times as much money, maybe 3 times as much money that 5 years later to catch up to the market gains. And where are you going to do the catch up from? Where's that extra catch up money going to come from? Your salary? Is that gonna fill the money the time gap that you've missed out on, the gains that you've missed out on for 5 years, for 7 to 10%? That comes up to maybe 70 to 70% of gains that you missed up. Is your salary going to increase that much over 3-4 years? No, you're never going to make that time up. Okay. Another important thing is your principal too. If you don't know what principal is, you can Google it, or maybe I'll make a video about it later. But you always want to protect your principal, which is your bottom line, basically. Principal is the absolute money that you are accumulating that you plan to use in retirement that is growing. Okay, maybe I should Google principal here for a second. I'm not gonna do it. You look at principal, but you're always wanting to grow your principal too. With time, the sooner you grow your principal, the more accumulation you will be granted. Which is more money for you in retirement. Okay. So backing up from time, then, if there were two things that I could change, it would be invest sooner and more often. Investing more often, use your tax return money, use that windfall and put that in the market today. Don't wait. Don't say, when's the best time? Should I wait for a correction, which is like a 10% drop? Or should I wait for the stocks to go on sale? Or, there's a bubble and it's going to burst. It's going to be the new .com Y2K, and we're going to at least see 50% decrease. Should I wait for that day? No, you should capitalize on the stock market today because of compound interest and dividends. Okay, I can't remember what the 5 things were that I listed off that I'm going to talk about, but time was one of them. But dividends and compound interest. So what is compound interest? Compound interest is basically, I'm going to read this off. It's the addition of interest to the principal sum of a loan or deposit. So in your case, we're talking about a deposit into a stock market account, or in other words, interest on interest, right? You're doubling down, okay? This is a great thing. So you want to protect your principal and grow it with compounding interest. It's the result of reinvesting interest rather than paying it out, so that interest the next period is earned on the principal sum plus the previously accumulated interest, right? This is compounding interest. This is a huge player in what you want to be aiming for when you're investing in stocks. It's going to happen, okay? If you're in the stock markets and you're investing in companies, you will see compounding interest, and you will see distributions, and you will see the fruits of that in stock gains and a higher return on your investment, basically. So that's a great thing. Compound interest, great. You okay. But what's even better than that? Dividends. Dividends, my friends. So think of this. You reach retirement. You've gone through retirement. You've invested in the stock market. Maybe some of the stuff you've invested in has had dividends. What's a dividend? Okay, it's a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserves, right? So when you're investing in the stock market, you're investing in companies. And you would typically want to invest in a winning company, right? That's going to produce strong profits, better than their competitors. You're in the best company for that category, and so therefore they're going to have the best profits. Potentially, then they do pay dividends, and guess what? The dividends are going to be high, and you're going to get a quarterly dividend payment that you can either reinvest or take out as a tax consequence, potentially, depending on what vessel or account type you have, if it's a tax account or if it's a non-tax account. But basically, dividends are amazing. Okay, number one, dividends. That's it, baby. If somebody's like, hey, do you invest? You got one word for it: dividends, baby. So last year, basically, I returned. This year. Last year I won't. This year and the last few years, I've returned about 3 to 4% dividends, possibly even more. I haven't added it up quite yet for this second quarter, but imagine that. Like, if you're like, oh, well, where's a safe investment? Maybe a certificate of deposit's going to pay you 1 to 2 to 3%, maybe 3. My dividends are paying 3% annually, and they have been for the past few years. So a guaranteed return of 3%. If you get into retirement planning, which is a whole different set of nuts and bolts, retirement planning 101, I'm going to make a video on that. If you get into that, you'll realize that tax advantage accounts and non-tax advantage accounts matter. And dividends are a strategy that a lot of people use in retirement, where they're like, okay, I'm just going to live off my dividends, which maybe are 2 to 3. Maybe your dividends are 3 to 4%, like mine are, And then what you actually need to live off of at the end of the year. So you've got $1 million portfolio, 3% of that's 30,000. So you got $1.5 million portfolio, 3% of that's, bear with me, okay? What's half of 3? 15, $45,000. If you can live off 45 grand in retirement today, you can live off your dividends if you got $1.5 million portfolio. You will be safe in 30 years span withdrawing those dividends, weathering ups and downs in the market accordingly with basically that strategy. Now, that's a loose strategy. Don't take that to your FA or your CFA or CFP, but use that as a guide, because safe withdrawal rate of 3% is typical. So if you got $1.5 million portfolio, you're taking 45 grand out, that's going to last you to 30 years of retirement. Saying you start retirement at 60, it'll last to 90, okay? So guess what? You can work this math problem backward and figure out how to retire early, okay? Which is the second video I'm going to tout, which is financial independence to retire early. What is early retirement? How do you achieve retirement? I will send you a video on that, because that is basically where I'm at right now. When you reach a point where your finances are at a state where you're independent of any other needed employer or W-2 or whatever, your income is enough that it's passive and it's generating more, that your 3% withdrawal rate that you back into when you really do need to start withdrawing from this is gonna make it. It's gonna last you the amount of years you need, right? But this is why dividends are so important, because you can gain, dividends, so you're getting the profits of the company versus a stock where if they're not paying dividends, they're not treating their shareholders very nicely, are they? Well, you should look into stocks that have a good price to earnings ratio. They pay quarterly dividends that are competitive, if not the best, and they also have a high opportunity for growth, which means they're, other balance sheet, type of factors. Look at that company, and look at Apple. They have tons of cash on hand. It's a good buy if you don't want to argue the fact that it's too high right now. Always buy low and sell high, right? So if there's a correction, you should be in a position to not scream and sell off your assets. You should be buying, because you want to buy low. If the price of the stocks drops dramatically, you want to be in a position to buy more to get a cheaper price, so that when it comes back up, you've reaped the gains of that drop. This is time in the market potentially, and I'm not going to get into time in the market because you really shouldn't. The only way you can time the market is with consistent, consistent asset allocation throughout the year, with dollar cost averaging, DCA they call it. If you're doing each paycheck putting money away, that's a DCA approach. You're buying the whole market throughout the year. You're gonna buy 100 different times, because there's basically 104 weeks in the year. If you're buying twice I'm sorry. Hello. If you get paid twice, you're gonna buy 12 times 2, 24. You're gonna buy 24 times into the market, okay? If you're DCAing every paycheck and you get paid twice a month, you'll DCA 24 times into the market. You'll be buying the entire market up and down that whole year, whether it drops 10%, goes up 10%. Sometimes it goes back a step, goes forward 2, back a step or 2, then goes forward 2 another. Imagine if you were getting 1% gains every day, and you're like, geez, my portfolio's up 1% again today. Over the course of the 200 and some days in the market, you're not going to get that. Okay, that's not realistic. You're not going to be up every day. You're not going to want to be emotional about huge losses some days, because they recover and they come back. And emotion usually largely drives the huge decline. But so keep your steady keel. Know why you're doing what you're doing in investing. Know about dividends, though. Know about compounding interest. Time is not on your side. You're going to die. The sooner you can get your money in, the sooner you can take your money out. It's that easy, right? I hope you guys have learned something useful for this investing video. Thank you again for checking out my LG channel. Life is good, baby. I really appreciate it. If you have not, please subscribe to the channel or hit the bell that's over there in the corner, and you'll get notified instantly of great investing videos like this and other videos related to IT and personal development, motivational videos, health and wellness and fitness. What else? Entrepreneurship, real estate. I'll probably cut a real estate video next. It's been a while. I don't know what I'll talk about, but thanks for joining me, guys. It's Kory again, the latest and greatest YouTube personality. You guys have a great night and do something awesome. See ya.